So today we're going to get into something that, well, it really caught a lot of people off guard. We're looking at two recent U.S. GDP reports for Q2 and Q3.
Yeah, and these are so important for you to understand because they give us this fresh look at, the real momentum in the economy.
It's not just if it's growing, but how fast.
Exactly. And in Q3, that speed was stunning.
Okay, so let's start with the Q2 surprise because the backdrop for this was pretty weak.
It really was.
Growth came in at 3.0%, a solid number. It beat the forecasts, which were somewhere around 2.5%.
Right, and that 3.0% was actually the strongest growth we'd seen in a whole year. And it came right after a really, really dismal start to the year.
Q1.
Q1. GDP had actually contracted. It went down by 0.5%. That was the weakest we'd seen since those, post-pandemic wobbles in 2022.
And if you look just at the consumer, that spending weakness in Q1 was pretty alarming.
Oh, absolutely.
Consumption was barely up. I mean, outside of the COVID crash, it was near historical lows. So that 1.4% consumption growth in Q2 felt like a huge relief.
It was a necessary rebound. Like the economy slammed on the accelerator after a really bumpy start. It went from negative right back into cruising speed.
But then we get to Q3, and it didn't just cruise. This is where it gets fascinating.
A complete shocker.
GDP expanded by a shocking 4.3% in that initial reading.
And, Dow Jones economists were looking for 3.2%, so it just blew right past that.
A full percentage point overshoot.
Yeah.
What on earth was driving that?
Well, the primary engine, once again, was consumer spending. It rocketed up 3.5%. That's a huge acceleration from Q2's pace.
So it wasn't just a one-off thing.
No. And we also saw increases in exports and government spending that really helped push it up.
Okay, so of all these metrics, what's the one thing the Federal Reserve is watching the most to see what's really going on under the hood?
That would be something called real final sales to private domestic purchasers.
Right.
It basically strips out things like inventories and government spending, so you get a pure read on consumer and business activity. And that rose 3% in Q3. It signals real, durable strength.
Which brings us to the critical counterpoint. All this amazing growth, but inflation, it didn't go away.
Not at all. Those price pressures were absolutely there through Q3, and that creates this core tension in the economy.
So what did the gauges show, the ones the Fed watches?
Well, core PCE, that's the one they really care about since it excludes food and energy. It actually ticked up. It rose to 2.9% in Q3 from 2.6% in Q2.
Still well above their 2% target.
Way above. And the market really noticed the chain-weighted price index, which jumped 3.8%, a full point above the forecast. That's broad-based price hikes.
And those price hikes translated directly into profits, didn't they?
Oh, spectacularly.
Yeah.
Q3 corporate profits just soared by an incredible $166.1 billion.
$166 billion, compare that to Q2.
Q2 was what, a $6.8 billion gain? So
Yeah.
this is just a massive, massive jump.
Okay, wait, hold on. So how can corporate profits be soaring by that much while inflation is still so sticky for everyone else? Aren't those two signals, aren't they supposed to be contradictory?
That is the central conflict. You've nailed it. It suggests that companies are raising their prices much faster than their own costs are rising.
So corporate strength itself is helping keep inflation high.
It's one of the key drivers. It puts the Fed in a really difficult spot.
So to sum it up, the economy is moving surprisingly fast, but it has this stubborn inflation problem that's kind of stuck to it.
Precisely. High growth and sticky inflation are living side by side.
And as one of our sources wisely put it, nobody ever really knows what the next quarter holds. That's just risk, and it's always there. But for you, the learner, think about this. With corporate profits surging by that staggering $166.1 billion in Q3, what does that extreme profit accumulation signal about where inflation might go next? Does it mean this problem is maybe deeper and more structural than we'd like to think? Something to mull over?